Amortization serves as a method in accounting to delineate the expenses associated with an intangible asset, reflecting the decrease in its value over time due to usage or elapsed time. This concept pertains to writing down the acquisition cost minus any residual value of an intangible asset in a structured manner throughout the asset's economically useful lifespan. While amortization applies specifically to intangible assets, depreciation is a similar principle applied to tangible assets. The approaches used to allocate amortization across accounting periods generally mirror those employed for depreciation. Notably, certain intangible assets, such as goodwill or specific brands, may be considered to possess an indefinite useful life, and as a consequence, are excluded from amortization requirements. However, goodwill is annually evaluated for any potential impairment. Although amortization theoretically recognizes an intangible asset's declining value over its useful life, in practice, companies may capitalize costs that would typically represent one-time expenses. This is achieved by classifying these costs as capital expenses on the cash flow statement, allowing them to amortize the cost. Such a practice can enhance a company's net income for the fiscal year or quarter when the expense is incurred. Within the financial statements of an entity, amortization is noted as a reduction in the carrying value of the intangible asset on the balance sheet and as an expense within the income statement. Under International Financial Reporting Standards, IFRS, the guidance for accounting related to the amortization of intangible assets is detailed in IAS 38. In contrast, the United States Generally Accepted Accounting Principles, GAAP, reference FAS 142 as the principal guideline for similar processes. In the realm of tax law, amortization serves as a method for recouping the costs associated with intangible property. The underlying principle of deducting amortization costs is to remove them from the basis systematically over the asset's estimated useful economic lifespan. This process aims to account for the asset's depreciation in value due to its usage, natural expiry, obsolescence, or other factors potentially leading to its decline. However, for policy-related reasons, there often isn't a precise alignment between income and deductions. For tangible assets, the analogous concept to amortization is known as depreciation. The approaches for distributing amortization among tax periods generally mirror those used for depreciation. Nonetheless, certain intangible assets, such as goodwill or specific brands, might be perceived as having an indefinite useful life or being self-created. Hence, they might not be subject to amortization. In the United States, congressional provisions allow taxpayers to claim larger deductions during the initial years of an asset's useful life. Intangible assets eligible for amortization are detailed in sections of the U.S. tax code and should be held for trade, business purposes, or income production. Prior to 1993, there were no specific cost recovery mechanisms for intangible assets within the tax code. Instead, these assets were depreciated following provisions typically applied to tangible assets. Many intangible assets failed to meet the stringent criteria for tangible depreciation due to the intangible nature of wear and tear, prompting taxpayers to often disregard any basis in these assets until their sale. According to Section 197 of the Code, most acquired intangible assets should be amortized evenly over 15 years, regardless of whether their actual lifespan is shorter. If an intangible asset doesn't qualify for this amortization, it can still be depreciated, given that its useful life can be demonstrated. Startup expenditures encompass investigatory costs incurred before embarking on a trade or business endeavor, which would have been deductible if paid or incurred while the taxpayer was already engaged in such activities. Unlike other tax code sections that generally prohibit immediate deductions for startup costs, Section 195 permits the amortization of these expenditures over a 180-month period. This provision is designed to motivate taxpayers to venture into new business opportunities. Amortization in the context of urban planning refers to a method whereby the value of a non-conforming use is gradually reduced over a predetermined period. Once this period concludes and the calculated value reaches zero, the non-conforming use must cease. This approach is often validated unless it is deemed arbitrary, discriminatory, or unreasonable. It is typically applied to specific uses and considered within reason when it provides an opportunity for a complete return on the initial investment. This practice, however, is not without controversy. Many advocacy groups focused on property rights criticize amortization because it compels property owners to discontinue a use that was previously lawful without offering compensation. Furthermore, in some jurisdictions, the amortization of a non-conforming use is regarded as unconstitutional, posing additional challenges to its implementation.